Get ready for a summer of soaring stock prices. The latest FOMC decision has set the stage for a market rally despite the challenges of high inflation and interest rates. We'll dive into what this means for your investments and why experts are predicting new highs for the S&P 500. Let's get started. Welcome back, everyone. Let's talk about the buzz with FOMC's latest move. The committee's recent policy statement and outlook have signaled that the S&P 500 is on course to hit new highs. Despite high inflation and interest rates, the U.S. economy is growing, labor markets are strong, and inflation is cooling off, even if it is slow. But putting this into perspective for us, if you would, Thomas, how is all of this likely to influence the stock prices this summer?
Well, right, like I say in my article, the Fed and inflation are just bricks of worry and a wall of worry. As you said in your introduction, the economy is still growing. It's still doing well. This morning, I was just looking at the Atlanta Fed's GDP Now tool, and their estimate is for second quarter GDP to be above 3%. The estimates are rising. That's an acceleration from Q1. That totally does not align with the idea of recession or economic weakness. So we're worried about high inflation. We're worried about high rates, but inflation is cooling. The Fed has got the policy where we think is a good place. I think that we're just climbing a wall of worry. The market should continue to rise.
So given the positive outlook here for the S&P 500's earnings growth, what sectors or maybe types of stocks do you think are going to benefit the most out of this current environment?
Oh, I think technology stocks are likely to do well for sure. We're talking about the usual suspects here, NVIDIA, Microsoft. However, the market is also always forward thinking. The expectation is that the next directional move for interest rates is lower. So buying stocks in sectors that might perform well when that interest rate cut happens makes a lot of sense. With that in mind, I know I sound like a broken record, but you're going to want to look at oil stocks. That's a good idea. I might even be looking at consumer staples.
Right. I was also just looking at the outlook for the next couple of years. Earnings growth, next couple of quarters for sure. And like technology, communications is going to be hot, but also discretionary is in there. Like you said, spending is still good. People are spending more on things than we were expecting. And with this Fed pivot that we're expecting to see next year should really unlock some discretionary spending. We're going to have lower rates. So for all of our big ticket items that require financing, we'll have lower payments. We'll have more free cash flow. So discretionary should be good.
All right, well, before we take a look further into interest rates, I want to quickly share with our viewers how they can get free SMS alerts about what's going on with the market in real time. Here's how. Want to keep your finger on the pulse of the market? Text the word YouTube to 68285. That's 68285 and get free breaking news alerts from MarketBeat for the stocks that matter most to you. Don't miss out on crucial updates. Stay informed and stay ahead. For over a decade, the FOMC's policy was a bit lenient. I mean, it wasn't until early 2025 that they began tightening rates to normalize the economy. Today, even though we're at a lower end of the historical averages, the Fed could hike rates again if needed to curb inflation. But for now, rates are expected to stay steady. So what factors are currently delaying interest rate cuts, and how might the timing of this decision affect the market going forward?
Well, I think what's delaying the cuts is just the pace of inflation and economic demand. This really goes back to 2020. We had a huge boost in demand because of social distancing. We had pandemic spending and we've got inflation. These three factors are all driving the economy. So we're trying to come in for this soft landing. The market, the economy is still in the glide path, kind of heading down to making that first touchdown, which should happen over the summer and early fall. And I think that that will be marked by when the Fed makes the first rate cut.
Of course, we have to mention inflation in all of this. The latest CPI report aligns with expectations that inflation will cool to the FOMC's target of 2% by 2026. However, this process is slow, as we mentioned, leaving the Fed little choice but to maintain current rates. With high inflation and interest rates as a concern, how do we see that these factors are going to play out in the near term? But also, what would happen if they did cut rates too soon?
Well, like Thomas was just saying, the Fed doesn't really have a lot of choice right now but to leave interest rates where they are. The Fed's concerned about repeating the mistakes of the 1970s, which means that if they cut rates too fast, you could see inflation spike much higher, and that would then tip the economy into a recession that the Fed is trying to avoid. I think that recession's already here and has been, but that's another story.
Right. Technical recession for
The
sure.
Fed sees the economy growing, albeit a slower rate, employment steady. However, I think one thing I noticed in Chair Powell's remarks this week is that even the Fed is starting to question the, how should we say, the authenticity of some of the data that they're receiving. I think that's something to watch going forward.
Right. Just to use some buzzwords, you know, way back when they began the rate hiking cycle, there was the new normal and higher for longer. And so that new normal is not new anymore. It's just normal. Higher for longer is what we're experiencing right now. The Fed's statements this week align with that idea of higher for longer, just whatever it takes to get inflation down. And they're just going to keep them up there until they're sure. And that probably, I mean, it might not be until next year. They could really hold up till next year before they make the first cut.
Right.
So if the Fed does not cut rates as expected by November, what impacts are we going to see from this?
Okay, I got a little soapbox to get on
All right,
here.
here you go.
I mean, I think the whole the inflation numbers this week were really a nothing burger when you get right down to it. I mean, we're talking about 1/10 of 1 percentage point in either direction, moving markets. I mean, it's silly. I know I do most of the grocery shopping in my house. I believe, Thomas, I think you're in the same boat with yourself. Prices are not going down. Now, I agree that we've gone from a 9% rate of inflation down to a 3.3%. That's not insignificant, but that's not the same as deflation, where you actually see prices going down. The patient is still gaining weight. It's just not gaining weight as fast.
Right. And that just comes into the whole idea of the soft landing.
Right.
If they don't cut rates later in the year, it will be because demand is still there. There's still expansion. So in that scenario, we're kicking the can down the road, but we would technically still be in that soft landing scenario. As I was saying this morning, writing my preview for next week, this summer could be pivotal. If the summer data continues to be in trend, we're in good shape.
Right.
But it could start to contract at any time. We got to watch out for that.
Right.
All right. Well, as we've been mentioning, the market is still showing signs of optimism, and the S&P 500 is in rally mode. Before we go, what are some of the technical indicators that investors should watch for to confirm this trend?
Right. So really what's driving the market higher is earnings. As we said before, inflation and the Fed are bricks on the wall of worry. What's leading the market higher is earnings growth. This year, the market returned to growth. Growth is accelerating sequentially. Annually, growth is supposed to accelerate from this year to next year, and that is a leading factor for the market. You see here, we had the market in a strong rally. This is the monthly chart, so it's a very long-term view. The market in a strong rally. We get this boost from the pandemic. We had this nice little consolidation pull back here, and then we break out. This to me is a very significant pivot point. The market is an organic beast. It's reflexive. So I think that it could easily move up an equal distance of this range to the top of the range. That gives me a target of 6,100. I think that could be reached early next year.
Thanks, Thomas. Well, it's clear that there's a lot to watch for as we move through the summer. We'll be right here at MarketBeat to discuss the latest market news. Drop a comment down below with your thoughts on the FOMC's decision and how you're planning to navigate the market this summer. Until next time, happy investing.